You may not like hearing this, but it's true. Dollar cost averaging by itself is average advice that will assure you get average results. Frankly, I don't want anything about my money to be associated with average. My role in this channel is to help you be the best silver or gold stacker that you can be by providing the best information and education I can. Yes, I need your views and likes, but that doesn't mean you're always going to like what I have to share. I get it. No one likes having their sacred cows being attacked. And boy, did some of you let me know. I mean, I really ruffle some silver stacking feathers. And for those of you that are just catching up, in my previous 2 videos, I kept challenging the idea that dollar cost averaging was actually bad advice. And I explained about why I was standing on the sidelines waiting for the best opportunity. I know dollar cost averaging has been sold to us as a great approach, and it does have its place in our investing playbook. While it does have its place, it doesn't mean it's the only play we run. Let me carry this analogy out a little bit further. I want you to think of yourself as a coach, and your investments are your players. Before each game, the coach comes up with a game plan that identifies the plays that you want to run based on your opponent. And in our case, it's the market conditions. The playbook is essentially an instruction manual that contains a number of plays, or should we say investing approaches and ways to take advantage of the defense, or in our case, take advantage of the market. I would submit that the dollar cost averaging is a great fundamental or even base play that you want all your players to know how to do and how to run it. But could you imagine what would happen if your favorite team simply ran the same play over and over again? They'd probably get crushed. As the coach, as your players get better and improve, or in our case, you become more educated as investors, the coach can open up the playbook more and start to call more advanced plays. The challenge is that these advanced plays require time and practice and training and education. And as investors, some of these advanced techniques and tactics require the same thing. This is why I pound the table over and over again so much about investing in you and your education first, because you truly have more time than you have money. In every video, I try to layer another concept or skill set or something to assist you in becoming a more sophisticated investor, capable of being more agile and responsive to the changing market conditions. As the coach of my team, I stopped calling dollar cost averaging play right at the end of 2021 and through 2022. Why? Because the short-term market conditions were shifting. Long-term, we look phenomenal, but in the short term, it was starting to look ugly. So I started calling my sideline strategy play. I was going to sit on the sideline, and instead of stacking silver, I was going to stack cash until the conditions changed either way. And at that point, I would call a different play. The problem is they don't tell you when dollar cost averaging doesn't work well as an investment approach. See, it works extremely well when the market is going sideways and even going up. However, it sucks when the market is going down or through a correction, because losing money is far more detrimental to your investing returns. There's an old example that everyone gives. If you had $1 and you lose 50%, you would have 50 cents left. And if your 50 cents goes up by 50%, you don't have $1, you only have 75 cents, meaning you're still down 25 cents. So ultimately, why did I call the strategy and how did it work? Well, I called it because, as I preach multiple times in this channel since I started in March of this year, we have to focus on conditions and not predictions. Multiple times in multiple videos, I have warned or shared my thoughts that ultimately precious metals will go much, much higher, but there were reasons to be concerned and price pullbacks should be expected. Let me just share a few clips real quickly from previous videos. So do I think in the short term we're going to see $23, $22 silver? Absolutely. I say this because I don't believe silver and gold will really take off until the end of this year. I've said several times in my videos and comments that I fully expect price to retreat from the 1880 range and likely all the way down to 1820 and hopefully no lower than 1780-ish. Watch out below because gold could drop as low as into the 1600s. What am I missing? What are they seeing that I don't? What do they know that I don't? With that, I'm going to suggest that we pause for a moment and think about our current financial position. While we want to hold as much physical gold and silver as possible, and we should, but we also need to ask ourselves some really tough questions. So I stopped buying silver and stacked the extra cash as I shared, because I was pretty certain that I would be able to purchase that same silver for cheaper later and thereby get more metals for my money, which is exactly what I preach on this channel. This is exactly how I've quote unquote made $2,500 by watching the S show of a market on the sidelines. Let's take a look at the numbers and I'll show you. Let's start by orienting you a little bit. For demo purposes, the dollar cost averager is in red and I'm in green. In red, our dollar cost averager bought $850 worth of generic rounds at $3 over spot. And in yellow, you can see the ounces, averages, and the total amount spent. In green, to try to make things somewhat fair and comparable, I've included the two purchases that I actually made and used the same purchase price as what the dollar cost averager would have gotten. So I took out that the premium was lower on kilo bars. In yellow, you can see the initial totals, but if you go down a couple lines, in brown, you can see what I could get if I purchased silver today at 1987, which actually it was 1933 yesterday, so it could even do even better. But regardless, I've highlighted that in blue and you would see my totals. So while the dollar cost averager who has been buying it as the prices went down would end up with 196 ounces at an average cost of $26.02. I'd have 64 ounces because I made those two purchases at $26.39, but then I would also now have 171 ounces that I could have bought as of yesterday, and my average cost would have been $22.87. So not only did I accumulate more ounces, but I accumulated it with a $3 per ounce lower cost basis. And so I have 236 ounces compared to the 196 or 40 more ounces at $3 of a lower cost basis. So some of you are going to say, well, that's not a big deal. Well, let's look at the numbers and see how they get amplified when it's time to sell. So I've created two scenarios, but for the sake of time, I'm only going to go over the first one. You can pause and look at the second one. But let's just say silver goes to like $60 and we both sell everything. The numbers tell the true story. I'd make an additional $2,500, which would be a 37% higher return. As you can see on the screen, the numbers are right there. Inevitably, some of you are going to be thinking about how much riskier this was or not worth the effort. And that's 100% okay. But at $60 silver, that's $2,500 of real profits that I would have for just sitting out for 6 months. And I'm not suggesting that sitting out is something you should do all the time. It has its time and place, just like dollar cost averaging. Let me ask you, if someone came back to you in January of 2022, January 1st, and said, hey, I'm gonna give you a little secret. Silver's gonna be down more than 20% halfway through the year. Would you continue the dollar cost average, or would you wait and let it finish falling and then decide to jump in at a much lower number? You would jump in at the lower number because we all know that if you can buy it cheaper, you buy it cheaper. That's all that I'm getting at. That there are times when you can make this move and amplify your returns. And ultimately, you didn't really take on any additional risk. Maybe the risk is that silver could have gone up and you would have a slightly higher cost basis. Again, some of you are going to think this is risky or maybe not worth the effort. I feel like it was worth the effort. Part of the stackers mentality you heard me talk about before. It's understanding that risk is not something that is avoided. It's something that it is managed. We can't avoid risk no matter what. Doing something has risk and not doing something has risk. How do we manage it makes all the difference in the world. It's also about our ability to look at data and conditions, as I always preach. It's why I do all these videos on the boring stuff. I know, like technical analysis and bond yields and the psychology or anatomy of a bubble chart. I do all these things because they give you really good information. And you don't have to be a David Morgan or you name whoever, a Rick Rule, to do well. There's just some basic things that you can learn that will serve you very well. All this information and data is why I've said from video number 1 on this channel that we have plenty of time, that it won't be until the fall that metals really take off. Ultimately, we have to learn to listen to the market. And yes, she talks to us, but it's in a whisper. And you have to clear out all that other noise and junk in order to hear her. So in a nutshell, as you walk away from this video, I want you to walk away with these 7 key points. Either way, dollar cost averaging or using like my sideline strategy, we both win. I'm just in the business of trying to win as much as I can. 2, like most investments, your money is made when you purchase, and how you acquire your metals matter. 3, I want to dispel the myth that dollar cost averaging is the only or best way to acquire your metals. 4, it's not about timing the market. I know someone's going to come at me and go, well, I can't time the market. It's not about timing the market. It's about understanding market conditions over predictions. It's understanding where the indicators are and what information you have access to and what is it telling you. Next, not every dip is for buying. Sometimes that pothole becomes a sinkhole, and your job as an investor is to be knowledgeable enough to understand what's the difference. 6, buying something as it's going down will cost you more money. And last, be flexible and agile. Have a set of plays that you can call as an investor or as the coach for any market condition. There are prolific investors out there, and they will tell you they can make money in an up market just as well as they can make money in a down market. What you have to do is to learn how to do that depending on the market conditions. With that, of these 7 key points that I just shared, which one did you find most valuable? Could you please go ahead and comment for me? And then tell me, what do you think about my sideline strategy, especially in hindsight? And as silver continues to slide, are you going to set a target price, or are you going to continue to dollar cost average into the market? I will tell you right now, just as a spoiler alert, it's a coin toss in my opinion. I don't think anyone would be making a bad decision at all if they started averaging in right now. I think the amount of downside in this market, I don't think it's that much further. Thank you for watching this video all the way through. You are my A+ students for seeing it all the way through. Always stack smarter, never stop learning.